This is Trepp Week in Review for the week ending October 20th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. This week, we saw volatility increase even as earnings season opened more good than bad. Bank earnings were better than expected, and Netflix stock shot up after it posted better than anticipated subscriber growth. But none of that could keep stocks from selling off on Wednesday and Thursday. Treasury yields surged over the last week as a miserable 30-year auction sent yields soaring. And investors finally seemed to recognize that the war in the Middle East could be long and drawn out. Manus, it seems like outside of the earnings surprise, there was not much to be optimistic about.
It was a very weird week, I have to say. In the early part of the week, I think people were really shrugging off what I would call a lot of worrisome news. We had seen the potential for the war in the Middle East to get dramatically worse. We saw that the war could expand to multiple fronts, not just Gaza, but also to northern Israel and Lebanon and so forth. And yet investors seemed quite sanguine about that on Friday, Monday, and Tuesday. We also saw a terrible 30-year Treasury auction late last week, which sent yields higher. And early this week, again, investors were quite sanguine. Stocks were either up or flat. There wasn't a lot of panic in the air. And it was surprisingly quiet in the markets on those days. And then all of a sudden on Wednesday, it seemed like people woke up and said, good golly, we could see a 5% 10-year pretty soon. We could see a 5% 5-year pretty soon. And yes, events in the Middle East could have ramifications that are far beyond what we originally thought, stretching to oil prices, involving other players in the Middle East, from Iran to Syria to China to Russia. And it's almost like the light switch flipped on Wednesday morning. And I do believe that that's the defensive strategy investors should be taking. We have a lot of uncertainties right now. The 10-year came within a fraction of a basis point of hitting 5% today. The war in the Middle East looks like it will be long and drawn out. A $125 barrel price for oil is not out of the question. $150 is not out of the question. When you put this all together, it's really hard to be bullish right now on anything from commercial real estate to stocks to bonds. And the benign reaction on Monday and Tuesday really took me by surprise. I think the more cautious footing that investors took later in the week seemed much more in line with reality than what we saw a few days ago.
Yeah, man, I think you could even make a case that the cautious activity that we've seen is probably still fairly moderate when you look at all of these ingredients. I mean, all of these things independent of themselves could be enough to send the market tumbling in previous cycles. All of these things kind of hitting at once. You know, we've talked about this at some length over the last year or so. It's almost like we have information overload, and we've seen so many potential catastrophic things happen that we've become a little bit numb to it. And so the market's reactions just don't match what you would expect them to. And it'll be really interesting to see. Israel's come out and said this is not going to be a quick war. This is going to be something that takes time. You have Saudi Arabia, you have all of these other players, you have Russia and China meeting this week. I mean, there's so much stuff. We're entering into an election year. I mean, all of this stuff is just has the potential for really bad economic implications for the U.S. and beyond. So, you know, if you remove all of that and just look at some of, you know, the weekly numbers that we typically look at, to your point, it's kind of tepid. You wouldn't see anything here that jumps off the screen. I mean, weekly jobless claims totaled seasonally adjusted about 198,000, which was a decline of 13,000 from the previous week and below the estimate of 210,000. Retail sales came in, reported better than expected, 0.7% up in September, which was a sign that, you know, households have continued buying power in the current economic conditions. And then I think the latter part of this week, kind of to your theme, we did start getting some news of some large corporate layoffs. So several of the big banks have started quietly cutting thousands of employees. So layoffs are coming. They've announced, you know, I think over the five largest banks, combination of about 20,000 positions have been cut so far this year, and they expect that number to continue to increase. This morning, I saw that Nokia was laying off 14,000 people due to the fact that their profits have been slashed. Geico has come out and said that they're going to lay off 6% of their workforce. So I know at the beginning of this year, we talked a lot about tech layoffs, and it was kind of concentrated in that sector, and the numbers were large, but it was isolated. Now we're starting to see some of the financial institutions, insurance, and others making a similar push to kind of cut staff. LinkedIn was another that said they're going to be laying off hundreds of people abroad amid a broader restructuring. So it'll be interesting to see how these layoffs start to impact some of the other numbers that the Fed's been looking at over the last several months.
Yeah, that was well put, all of that. And I agree with everything that you were saying, especially the beginning when you were talking about how the market reaction, while negative, was not so negative that people are panicked, right? We saw stocks down modestly, really, when you take into consideration Wednesday and Thursday's losses, really just a flesh wound compared to other sell-offs that we've seen over the last year or two. So the reaction was really quite muted. Two other observations to what you said. One, I say tongue in cheek, the other not so. On the Geico side, how about a fewer gecko ads during the NFL football games before you start cutting bodies there? I'm having gecko overload during my Sunday afternoons. I would have preferred them to say we're going to cut back on our marketing budget rather than cutting 6% of our employee base. On the bank layoffs, to me, this is a bit of a tell. And I'll see if I can get into this a little bit. Banks are like an accordion. When rates are low, loan originations are robust, and they maintain a really hefty loan origination team and a loan servicing team. When rates go up, layoffs usually come very quickly. They're very painful. They're deep, and banks cut their staff quickly and sharply. They have not really done that to any significant degree since rates went up, which is now 18 months since we really started seeing the Fed hike aggressively. In my mind, the fact that they're only laying off people now tells me that this is a form of capitulation. For the last 18 months, they were thinking this rate hike thing is a spike that's not going to stick. The Fed will go wobbly, rates will come down very quickly. There's no need to get rid of our staff. The fact that they're doing this now, to me, says that they're finally capitulating, that they're finally saying rates are going to be higher for longer. It's now time for us to reduce staff, and loan originations, particularly on the residential side, are not coming back anytime soon. And by the way, we saw a new milestone, an ignominious milestone this week, with 30-year mortgages ticking above 8% for the first time in, 15 years, 20 years. The 30-year fixed rate average mortgage now 8.03%, according to CNBC this week. So a lot going on there. I do promise you, we have an awful lot of green shoots this week, particularly in the retail segment of this. We have an awful lot of crabgrass on the office segment as well, but we'll get all into that more.
Yeah, it's interesting on the single family interest rate stuff, man. It's our friend Jeff F., that's a listener, posted a nice meme this morning that's not really a meme, but his mortgage company sent him an advertisement saying, today's rates 8.3% or something. Call us to see how you can save on a house. And so to your point, I mean, like, how do you sell that if you're in originations when people are locked in at 3.5% on a 30-year fixed rate and current rates are over 8? But they're trying, and I guess someone had posted on Twitter, well, it's cheaper than credit card interest. So if someone has a bunch of credit card debt and they can consolidate with some home equity, maybe that's a better play, but still it's a pretty tough sell in today's market.
Yeah, I want to stick on this point for just a moment. I wasn't planning to get into this today, but you kind of segued it nicely into something that I'm going to run through kind of quickly. This was a really popular segment we did 2 months ago, and I wanted to repeat it here, and I certainly will repeat it once every month or two. I wanted to give people a sense of where rates are on commercial real estate loans that are newly securitized here. I can't give the name of the loan away because some of these loans are still in the market right now, But I wanted to give you, Lonnie and Haley and our listeners, a sense of proportion of where loans are getting made right now. There's a deal in the market right now. Most of the loans are 5-year loans. The weighted average coupon on the pool of 28 loans is 7.15%. But that really doesn't tell half of the story. And I'm going to give you a couple of examples here. There's a hotel portfolio in this, which is probably 2 or 3 hotels. The loan size is under 50 million. LTV 61, occupancy rate pretty good, 76%, which is great. Limited service portfolio, 8.77% coupon on that particular loan. A retail loan, this is an anchored retail shopping center in the Midwest, 65 LTV, 96% occupancy, 7.64%. Medical office building in Chicago, 8.65% on a 42 LTV loan there. So on the other side of the coin, what we're seeing is in the multifamily side, we do have, or mixed use, I should say here, a loan rate of 551 for a mixed use property in Massachusetts with a 49 LTV. Where I'm going with it is, if you will cull through some of this new issuance that's going on and looking at the loans that are getting made, this could be very informative for you as either a lender who's trying to get data points or a borrower who's trying to size up what you might be looking for in refinance. And it does give you a pretty good sense of the latitude of rate right now. A year ago, the distinction between low LTV multifamily and higher LTV office was fairly narrow. Now we're seeing a band where the strongest and lowest rate loans being made can differ from the highest rate loans by 350 basis points. And as we see some of these deals priced, maybe next week or the week after, we'll assign loan names and property types to these so people can get a sense of what we're talking about here. I'll give one more. This is a big one. This is an outlet center mall. This is a pretty big one. In this particular case, 1.7 DSCR, 50 LTV. In this particular case, 7.85%. So probably 300 basis points over the 5-year where this was made. So not cheap for borrowers to refinance. And it does explain why extend and pretend is really, really settling in as the option of choice for many borrowers.
So on a similar note, last week we asked our listeners for some recent market data on new originations and construction data, and a listener, Christopher J., shared some info.
Yeah, so this is a perfect segue, Haley, from Annis's recent discussion there around current pricing in the market. So Christopher J. sent us a couple of deals, new construction or conversion deals with a really nice write-up in detail. So we're very appreciative of his response. And, I got to say, as we've been doing this, every time we've asked for somebody to send something in or give us some perspective, our listeners never let us down. They always do a really great job of providing that boots on the ground perspective. So let me just go through these quickly. This is a ground up construction project, about 116 units, market rate multifamily just south of DC. It does have around 5,000 square foot of ground floor retail. They've chosen to use a regional bank for financing. Loan balance is going to be just north of 17 million, and it's set to close here at the end of the month. Here are some of the terms: 80% loan to cost, max 75% loan to value based on as complete appraisal. DSCR is the constraint right now for all of their deals. It seems like this lender stressing the permanent financing at 7.9% with a 30-year AM, and the loan has to have a 125 DSCR based on, appraiser approved pro forma financials. If the DSCR is less, then obviously loan proceeds go down until they hit the threshold. It's 24-month construction loan. It's 1 month SOFR plus 220, and that's with full recourse. So we know a lot of our listeners try to stay out of the full recourse game. It looks like in this instance, that's what's required. When they get to the permanent financing, they have some partial recourse capabilities there as long as they have 125 debt service for 90 days. No prepayment penalty if they decide to go to agency or insurance company, and there's some incentives if they stay on with the current lender. He also sent in a couple of office to multifamily conversions, which I think is really interesting because this is a data set that's really not matured in the market because we haven't had a lot of these projects actually be undertaken at this point. So really great, valuable information here. This is an office to multi conversion, going to be 91 apartments with another 5,000 square foot of ground floor retail. This is part of Virginia Beach MSA, market rate multifamily. Again, regional credit union, $11 million loan. Again, closed this month. This one here, though, is interesting. 57% loan to cost. They are using historic tax credits on this deal to lower the loan to cost because they can apply the tax credit against the cash against the loan. It does have a 70% max loan to value based on an as complete appraisal. And just like the previous DSCR is the constraint here, lenders stressing permanent financing at 6.9 on a 30-year AM have to meet the 125 DSCR threshold. This was also full recourse. Last one, office to multi, same Virginia Beach MSA, 64 apartments, 5,000 square foot ground floor retail office to multi conversion, $9 million loan. This one already closed a few months ago, 55% loan to cost. Same issue where they could apply the tax credit dollars against the loan, max 70% loan to value based on an as completed appraisal, same stressing at 6.9 on the 30-year AM. I think from my perspective, this looks pretty much in line with what you were talking about, Manus, on the 5-year paper a minute ago. Lower loan to value ratios than what we've seen over the last 3 to 5 years. Obviously, the lenders are stressing these at a higher permanent financing rate upon completion. And that 125 debt service coverage is really driving what loan proceeds can look like on a stabilized basis. So thanks for the insight, Christopher. We definitely appreciate you sending it out. And hopefully for our listeners, this just gives you a little bit more market color from somebody that's actually executing on these deals in real time.
It goes back to my point that I said continuously for the last, 6, 7, 8 months. Some people call me Pollyanna for making this point so often, but it is true that velocity isn't zero, right? We're seeing sales, we're seeing leasing, we're seeing lending. It's nobody's popping corks at the velocity that we're seeing, but deals are getting done. Nobody's out buying new 60-foot yachts in this particular market, right? We're probably off 60%, but the trickle we're seeing is encouraging. It's much better than we saw in the early 90s and much better than we saw in 2009. So I continue to hang my hat and my hopes on the positive news we see with some people are lending and some people are buying and selling. So
let's jump into our property type segment. We're going to start this week with some retail stories.
Yes, this is very much a tale of two property types going in very different directions. I started talking about that maybe 10 minutes ago. A lot of really good news in retail, a lot of disappointing news in office. So we're going to start off with the retail. Let me start with the couple of negative stories we have, and then I'm going to run through some really good stories down the road. One of the headlines we saw this week, some of our readers may have noticed this in yesterday's Trepp Wire, Rite Aid, which is going through the bankruptcy process, announced it is closing 150 stores. Our crack research team at Trepp, including Stephen Bushbaum and Emily Yu, jumped on that list and created a map which mapped all closing Rite Aids to CMBS debt, and that's available on our website right now. Thank you to our research team for putting that together. That was, I would call that a bit of a green shoot, just because I think I was expecting more store closures from Rite Aid than 150. So a modest win in that regard. A story that got incredible traction on Twitter this week. I think we had about 80,000 people view this particular story. We broke this on Tuesday evening. October servicer data revealed that the $100 million mall at Tuttle Crossing loan had been resolved with a loss of $93 million. Before anybody takes off their shoes and socks to do the math, that's an 87% loss based on the most recent balance of the loan. The collateral had about 385,000 square feet of inline space in a Dublin, Ohio mall. The entire mall totaled 1.1 million square feet. The note had been with special servicing since July 2020 and had been delinquent most of the last 3 years. What made this story so noteworthy is that the loss wiped out the BB, BBB minus, and part of the single A classes for some CMBX reference obligations, CMBX 7. So in this particular case, this loss means that if you were short CMBX 7, whoever was insuring your portfolio now has to write you a check for the loss that was made by the mall at Tuttle Crossing, for this enormous loss that took place this week. And by the way, if you missed this on Twitter, you could see the story there, but you're happy to reach out to us and we'll share with you the details. If you are the long provider, if you're the insurance provider, you're the one who has to write a check to the shorts to cover this particular loss. Even though losses have been expected on CMBX 6 and CMBX 7, BBB minus, because of retail losses of this size, they have been few and far between thus far. This is one of the few that have taken place. If you want more of the nuts and bolts as to how this insurance works, we could point you to an older podcast where we did an educational segment on this, where you're certainly free to reach out to me, and I'll be happy to go through it with you via LinkedIn or email or anything else. A couple of other pieces of crabgrass in New York. The collateral value of the Destiny USA Mall in and around Syracuse was lowered again. This particular mall had been valued at over $700 million in 2014. The aggregate value of the two phases right now is down to under $125 million. An extraordinary drop in value, really about 86% over time. Yet the owners still continue to fight for this mall. Good for them as they continue to try to make this work. Elsewhere in the crabgrass space in San Francisco, the $50 million One Union Square mixed-use property loan was not paid off when it was slated to mature this month. The property is about 42,000 square feet of space at 212 Stockton Street. I call this a retail property because the top tenant is Bulgari, which has 38% of the square footage on a lease that ends in 2025. You know, Bulgari has that street level retail, which is usually a very expensive and very high rent for the upscale retailers in places like New York and San Francisco. So let me allow Lonnie to jump in for a minute, and then I will run through the plentiful green shoots we have this week in retail.
Yeah, I guess I really just have one question on that segment, Manus. I was crying myself to tears over here, hearing all the crabgrass. But on the mall that went from 700 million to 125 million, I mean, what do you think spurs the current ownership to stay with that? I mean, are they at least cash flow positive to a point to where it's, you know, somewhat worthwhile? I mean, like, I don't know how you ever dig out of a hole like that, given such a dramatic cut in value. I mean, like, that one's not one where, you know, it lost 30% of the value, the asset stabilized, you think there's some upside in re-tenanting some of the space. I mean, in this case, that's got to be pretty close to the land value. You know, do you have any thoughts on that?
Yeah, I'm gonna bring it up as we speak. A couple of random thoughts. The first thing is that it's not cash flow positive, it's cash flow negative. The DSCR on this thing has been under 1.0x since 2020. So there is no cash flow positiveness. If I'm not mistaken, I think there's also debt in front of the mall, if I'm not mistaken, some opportunity zone debt that was done beforehand, and occupancy, at least on the phase one, is only 57%. So it defies logic on the one hand, but on the other hand, they're not unique. We've seen a dozen stories like this where borrowers are negative equity to the tune of 50% of the property value, yet they continue to lean in. I think part of it is, in some cases, this is still family money. They've been around for a long time, and these properties mean something to them. And in other cases, I think it's all they know, right? If we're not going to try to run this mall, what do we do next? It's like a ball player who retires at 38 and says, I don't know how to do anything else. Like, that's all I've done since I've been age 8. And I understand that. Like, this is what we knew. We're going to fight for this thing. It's in our DNA, and we're going to keep going. But the X's and O's don't add up.
Yeah, Manus, I agree with you. I think you kind of laid it out there where sometimes the X's and O's don't line up, but for whatever reason, there's an impetus for them to continue, forging along with the asset. I would tell our listeners here over the next couple of weeks, we are going to have a guest pod with the CEO of Spinoso Real Estate, who operates a lot of these regional, super regional malls across the country. And I think this is something I'd love to dig in with him and say, when this type of situation happens, what are some of those nuances that maybe keep somebody in the space? Or, how has his company been able to kind of leverage some of those situations to buy assets at a reset basis and really turn them around and make them profitable? So I think the timing on this discussion and the timing on our pod with him was actually going to line up really, really nicely.
Yeah, we spoke to him earlier today. All three of us were on the phone with Carmen Spinoso, and I got to say, I'm really looking forward to that. The amount of knowledge and his history in this marketplace, I think, is going to be incredibly enlightening, not just for our listeners, but for me as well. I think that it's incredibly timely. I should correct the record on one thing. The phase one part of Destiny Mall, deeply underwater on a DSCR basis. Phase two, above water, so probably on a blended basis, they probably have close to a 1.0x DSCR between the two portions of that. So they're holding out for a miracle. They did manage to get a maturity extension a couple of years ago, and they have another 9 months before that loan matures, and they're looking for, I don't know, that miracle. Maybe pickleball will be the miracle they're looking for, right? We see everybody trying to capitalize on that pickleball fad to try to bring people into the mall. So let's go through the green shoots very quickly. In New Orleans, the Shops at Canal Place paid off ahead of its January 24 maturity date. The loan made up 19% of a 2014 CMBS deal. It's a pleasant surprise for CMBS investors. The mall lost a high-end movie theater in 2019. In 2021 and 2020, DSCR was below 1.0x. The collateral contains 220K square feet of mall space. In H1 2023, DSCR was 1.24x. So 1.24x, not the kind of DSCR you expect to get a payoff out of. You're thinking maybe this is a stand and pretend type situation, but no, we get the early payoff there. In Los Angeles, the $175 million Beverly Connection retail loan has cured. I love this story. This came from October servicer data. The loan had been delinquent for 3 years. The property is a 350,000 square foot asset at 100 North La Cienega Boulevard in LA. Top tenants include Target, Marshalls, Ross Dress for Less, and Nordstrom Rack. The cure really came out of nowhere on this particular asset. The loan, which is $175 million, was split across several 2014 CMBS deals. This story was broken by Commercial Mortgage Alert last week. A $235 million loan on the mall in Columbia has been originated by Morgan Stanley, Barclays, and 3650 REIT. That loan will retire a 2020 SASB deal. The property is a 1.3 million square foot mall in Columbia, Maryland. The outstanding 2020 loan is a $250 million loan, which is slated to mature in December. The borrowers under that loan were Brookfield and Nuveen. They were out of extension options, so this will retire a 2020 SASB deal. For 2023 H1, DSCR there 124 when occupancy was 95%. In Hanover, Maryland, another Maryland story, the Arundel Mills Mall paid off ahead of its 2024 maturity date. October remittance data said the $384 million loan was paid off ahead of its 2024 maturity date. The collateral is a 1.5 million square foot super regional in Hanover, MD. This one was a really strong performer. For H1 2023, DSCR was over 3 and occupancy was 95%. This debt was split across 3 2014 CMBS loans. And in Roseville, CA, this story comes from the Sacramento Business Journal, the Creekside Town Center in Roseville sold for $125 million. This is said to be one of the largest sales in that area in 2023. The sale equates to $337 a square foot. The buyer was Kane Company Management. The mall last sold in 2010 for $94 million. So we're talking about a 33% increase in value over the last 13 years for a Creekside shopping center. So a lot of good news out there, and we're just so happy to report it.
Yeah, I would echo the sentiment on the Beverly connection. Really great news story there. The 2020 SASB loan, that's pretty indicative. They're taking out a new loan at 235, extinguishing the previous loan at 250. So the borrower had to come to the table there with pretty much a minimum of 15 million to kind of get that deal locked up. And it looked like they didn't really have any other options since they were out of extension options. So again, some perspective on what it's taking to get deals done in this credit constrained market. I'm surprised it was actually, they were able to get 235 with 1.24 debt service coverage, especially when occupancy is at 95%. So it'll be interesting to see how that mall plays out, but good news for them. They're able to get into a new facility.
Spinoso Real Estate Group's industry-leading mall investment and operating platform is positioned to capitalize on a historic opportunity in the retail real estate market. With a team of seasoned experts, they offer a comprehensive and proprietary platform that identifies unique mall investment opportunities, conducts meticulous due diligence, and implements winning strategies. SREG's proven track record of executing value-add strategies includes operating over 80 malls at 72 million square feet. The time to invest and capitalize in malls is now. Partner with Spinoso to maximize on a historic opportunity. For more info, visit spinosoreg.com. So we had a lot in retail, but I think we have even more in office this week. So let's turn to that segment.
Yes, office is one of those moments where you may want to pause the podcast, go back and get that second glass of Cabernet, sit down, put your feet up, and just try to get into a Zen mode for a few minutes, because the crabgrass, while not just crabgrass, there'll be some green shoots on Lonnie's end with new leases. There is an awful lot of crabgrass in office. And I do feel like we had an inflection point in March when we saw Brookfield and Blackstone and PIMCO turn the keys back or announce that they were turning the keys in on several large assets. And we thought, wow, this could be the beginning of something big. We then went through 6 months where I'd say distress was up in office and up considerably, but it was kind of measured. It was taking place a little bit at a time. This particular month was, I would say, a deluge of new events that took place. And it feels a lot like March did in terms of the numbers that we're seeing. So let us start with another one that got an awful lot of traction, both with our Trepp Wire readership and on Twitter. This one we broke earlier this week. According to October remittance report, the $399 million 1440 Broadway loan was sent to special servicing. Not a huge surprise that the loan went to special servicing. We're seeing a ton of that happen in the office space. It's happening every month. So that part of it was not the real crabgrass. The real crabgrass came from the special servicer commentary, which noted, and I quote, "The borrower will be deeding the property back to the lender." So this is a property and a loan that was current and remained current through October, had never shown distress before. And rather than commit to working with the special servicer to try to work this out, the borrower, at least in the initial move being made by their indications, is jingle mail. This particular loan backs a 2021 single asset deal. The collateral is a nearly 750,000 square foot mixed use property at 41st and Broadway in Manhattan. So really in that Times Square district. The problem there was WeWork was the top tenant, 40% of the space. We know WeWork's issues, that a bankruptcy filing is not out of the question. And, that appears to be the issue. For the 12 months ending in March 2023, DSCR at the property was under 1.0x, even though occupancy was 91%. So obviously that WeWork potential departure has not been reflected yet in the occupancy. That was our biggest negative story for the week, but I'm going to cut through several more I'm going to start with the special servicing transfers. In Philly, the $223 million 1818 Market Street loan went to special servicing. It's worth noting that the loan does not face a near-term maturity date until March 2024. The loan backs a single asset 2021 deal. So again, another 2021 originated loan. The collateral contains nearly 1 million square feet in Philadelphia. For the 12 months ending in June 2023, DSCR was 1.06 when occupancy was 80%. This looks like a situation where DSCR was crushed, not by tenants leaving, but by higher debt service costs. Another loan that's in the hands of the special servicer. A 2019 office portfolio loan also went to special servicing. This is the $325 million Brookwood office portfolio. The loan is backed by 25 offices and 2 industrial properties totaling 4.3 million square feet. Most of the properties are in Pennsylvania and Texas, with a smattering in California and Florida and a few other states. DSCR there for the 12 months ending in June 2023, 1.02x when occupancy was 77%. So some really big transfers this month.
But I'll tell you, I think we're just on the cusp. Like, we've been seeing delinquency rates increase in the office sector for the last several months. We're up over 5% now. Our research team actually went through and did some analysis on 2023 issuance this year. So just to add some perspective for, urban office issuance or suburban office issuance, urban office issuance in 2023, weighted average origination debt yield was 14.97 and loan to value was 43.9%. So typically lenders target a 10 debt yield. They're basically at 15. And if you look at suburban office, they're at 15.22 on the debt yield, 52% on the loan to value. And so, we ran some additional calculations to say, looking at upcoming maturities, so office loans that mature between fourth quarter of 23 and second quarter of 24, there's about $25 billion worth of urban office loans maturing in that time period. You add in the suburban, it goes up even more. The weighted average in-place debt yield for those loans is 8.8%. We just highlighted that current underwriting presupposes about a 15 debt yield. If you say that maybe these are strong sponsors or they have a reputation, they might be able to get the lender to take a 12% debt yield. Refi proceeds today on those properties would only be 74% of the current loan balance. So just basic math, 25 billion in urban office maturing, 18.35 billion in refi proceeds would require cash in of 6.6 billion from borrowers. And I think, that narrative is starting to play out. WeWork is a large tenant in a couple of these deals where it's just not viable at the current basis. And so the lenders are going to take these properties back. And I think for me, it's just what happens next. I don't think it's going to be the office to multi-conversion at scale. And these lenders are going to have some decisions to make as these properties, which there's a lot of them, the lenders are forced to take these properties and decide if they're going to expend a bunch of TIs. And there were some stories this week that talked about bondholders rejecting certain leases on some of these properties because net present value calculations of those new lease terms with TIs and everything else is a net negative for them. So we're starting to see a little bit of the hair in the office sector is I guess my takeaway from this week's crabgrass.
The WeWork story is it's like the thing you used to learn in physics, back in the day, the potential energy versus the kinetic energy, right? Kinetic energy is moving energy. Potential energy is like a spring that has yet to be sprung. WeWork is the kinetic distress, and expiring leases is the potential distress. For guys that are facing lease expirations in 25 and 26, you're cash flow positive, but you can't refinance because nobody's comfortable that you'll be able to renew these leases, or if you do, you can get the same rent you were getting 5 or 10 years ago. On the WeWork thing, that's the here and now. WeWork is on the cusp of bankruptcy. They will be rejecting leases, and once those leases are rejected, in some cases they already have rejected leases, even though that they're legally not permitted to, Once that happens, that's the here and the now. That's the cash flow has stopped, and the borrower then is faced into a decision: do I keep this going with money out of my pocket, or do I call it a day? And those are two vastly different outcomes. So let's get back into the crowd. All of these next ones are about values, and I will bucket them into a couple of categories. Category number one, WeWork related. The first one is 315 West 36th Street in New York City's Garment District. The property backs a $77 million loan. The value was cut by 2/3. Collateral is a 140,000 square foot office. WeWork had been the dominant tenant with 93% of the space. The property was valued at $127 million in 2018. This month, the value was lowered to $42 million. So a drop, as I said, of about 2/3. And now that particular property, which backs a 2018 CMBS deal, is now $30 million in negative equity. In San Francisco, I think this was once occupied by WeWork, although I may be misspeaking here. This is a really disappointing comp here. 340 Bryant Street, which was a single tenant property at 340 Bryant, of course, in San Francisco. This is a 62,000 square foot urban office. This month, the value was cut from 52 million to just 8.2 million. So we're now talking about something that has gone from $835 a square foot to $132 a square foot as of an August 2023 valuation. In Connecticut, Constitution Plaza in Hartford, the value there was dropped from 94 million to 46 million. This particular property backs a $51 million loan. The collateral is a 660K square foot office in Hartford. The loan missed its balloon date in May 2023. The loan is now underwater by about $5 million. Again, this is a 2018 CMBS loan. In Houston, One City Center, which backs a $100 million loan, has seen the value of that property drop by more than 80%. This particular property is a 600,000 square foot office. Long ago, we noted that the anchor Waste Management would not be renewing its lease. They would be moving on. Waste Management occupied 40% of the space. The loan was being maintained as current as a function of a big reserve that was in place. That reserve was depleted recently and the loan became delinquent. The value of that property was reduced from 162 million in 2015 to just 30 million, or about $50 a square foot, based on this latest appraised value.
Only comment on this is the Houston office story here with Waste Management relocating. And those Houston office markets, I mean, they fluctuate up and down like crazy. It's one of those office markets where, depending on where we're at in the cycle, you can see sales prices at less than $100 a square foot, or you can see them at significantly higher than that. So hopefully for them, Houston as the MSA, like, I know multifamily has been really strong there, and hopefully for the office sector, with some employees coming back to the office, we'll start to see a resurrection there in the Houston CBD.
And very quickly, in Chicago, 175 Jackson, the value of that property has been lowered from 195 million to 165 million. This property backs 250 million in CMBS debt. So now we're talking about $85 million underwater for that particular asset. Elsewhere in Chicago, 111 West Jackson Street has also been lowered. That property was valued at 163 million in 2017. This month, the value of that property down to just 66 million. So we're talking about a cut of almost $100 million. In suburban Chicago at the Riverway, there's a $114 million loan on that particular asset, which is an 870,000 square foot office. That particular property was lowered in value from 176 million in 2016 to 101 million this month. So about 12 million in negative equity there. And lastly, a story we've been covering for many, many years, 2 North LaSalle in Chicago. This month, the value there was cut from $100 million to $60 million. This particular asset backs 137 million in CMBS debt. So we're talking about almost 80 million in negative equity. Negative equity on the debt. The debt is split between an A note and a B note. Even the A note now is $40 million in negative equity. So for those that want to see these data points, we posted them all in Trepwire this week. If you have questions on any of these, I'm happy to share the details with you, but a lot of bad news in Wrigleyville.
Yeah, and we actually posted on Twitter and LinkedIn this week an excerpt from our Julianne Cavalieri that did a rundown on the Chicago marketplace using our Trepp Insights business intelligence tool. So if you want to find those posts, there's about a 1.5 minute long video that she walks through some pretty nice analysis of that market in real time using some of our tools. If you'd like to see a demo of that or have us run the similar analysis for your local market, please reach out to us at podcast@trepp.com. We'll be happy to set something up for you.
And I use that term Wrigleyville broadly to represent all of Chicago. Wrigleyville is technically a neighborhood in Chicago. I'm really talking about the greater Chicago MSA as being bucketed for those 4 stories. So for those Chicago denizens that wanted to call me out for speaking improperly, I wanted to preempt you on that one.
Yeah, I was at a Cubs game earlier this year, Manus, and down there by the stadium, there's a bar I think it's called Sluggers, where there's a batting cage inside the bar. I was reminded very quickly that I'm no longer in baseball shape, and for about 3 days afterwards, my back was letting me know that I didn't stretch properly before taking a few hacks in the cage.
I was always shocked that I never blew out my elbow trying to throw the ball on the speed gun. Right. You'd go from your office to a ball game. You'd walk into the speed gun thing without any limbering up at all. And you'd grab a baseball and throw it as hard as you possibly could. The fact that I didn't end up at NYU Langone needing Tommy John surgery after doing that stupidly in my 30s and 40s remains one of life's mysteries.
Yeah, I think that that game has definitely torn some rotator cuffs and ripped some elbows up over the years.
And Lonnie, we also have a bunch of leases that we've been tracking across the country.
Yeah, so we'll run through these quickly. First one comes from our friend Alex Halverson, a Puget Sound Business Journal. Pokemon International is expected to lease a large space in a 25-story office tower under construction. This building's in downtown Bellevue. The company, which is a subsidiary of Pokemon company in Japan, is said to be eyeing the new Skanska USA commercial development called the 8 Project, which is scheduled to finish early in 2024. That property sits at 108 Avenue Northeast and Northeast 8th Street. According to the story, they haven't signed a lease yet, but industry sources are saying that a deal is right there for the taking and should be somewhere in the tune of about 300,000 square foot, which would be about 60% of the overall square footage in that tower. So we'll keep an eye on that one. Another green shoot here, this is from Laura Waxman and Roland Lee. OpenAI is going to sign a 450,000 square foot lease in San Francisco. We've had multiple stories over the last month or two around AI firms signing large-scale leases back in the Bay Area. So hopefully this artificial intelligence leads to a little bit of a resurgence in that market that definitely needs it. The New York Post reported this week, Ralph Lauren renewed its 250,000 square foot lease at the Starrett Lehigh building, 601 West 26th Street. This is one of RXR's buildings. And according to the story, rents range in that building somewhere between $60 and $79 a square foot. Rebecca Baird, a story of the New York City Administration for Children's Services extended its lease. They lease currently most of the building at 150 William Street in the financial district. That's according to public records. This agency recently added on 2 years to their existing 530,000 square foot lease, which backdates it to September 1st and now runs through August of 2025. So that was according to the Department of Citywide Administrative Services, which handles all the leasing responsibilities for the city. So those were the green. We did have a couple of crab here. Alex Halverson, again, from the Puget Sound Business Journal, notes that DocuSign, Meta, and Oracle collectively between the 3 companies shed almost 330,000 square foot of office space in Seattle last quarter. That's according to an office report that was put out by CBRE. Oracle shrank its presence in Seattle by just under 100,000 square feet, and that was primarily concentrated in the Century Square Tower. DocuSign downsized as well, which was also known as the DocuSign Tower. Sarah Clearman from the San Francisco Business Journal says that Microsoft has placed its offices at 555 California Street up for sublease just weeks after announcing its plans to open an artificial intelligence focused space in that building. So we'll see what is more to come on that. You know, that's a little bit of a contradiction relative to what was reported a few weeks ago, but we'll see how that plays itself out. And then Cody Baird of the Austin Business Journal wrote that Indeed put 100,000 square foot of its new tower lease available out on the sublease marketplace. So a lot of stories there. We did have one other one that was related to some of the New York office stories that Manus mentioned earlier. This was according to Bloomberg. Hedge fund Third Point is looking to sublease, you know, either some or all of its current space at 55 Hudson Yards. This is on the west side of Manhattan. The article notes that the firm is looking to take advantage of high rents on new offices in New York City. The 55 Hudson Yards office tower was new construction, completed in 2018, has more than 1.4 million square foot, and Third Point is the fifth largest tenant, currently occupies just over 6% of the space, and their lease runs until 2029. So we'll see what happens there if they're able to get that space subleased, and if that can be a positive story for, you know, Hudson Yards, which is to this point been, you know, pretty stable from an office perspective. That flight to quality has really been felt in a positive way for the office operators there in the Hudson Yards market.
Ani, salvaging the office segment with a handful of green shoots. Thank goodness. You know, at least we had a couple of leases out there that we could pin our hopes on. And the good thing about those leases is, you know, several of them were 400,000 square feet and up. So thank goodness there was a couple of green shoots. Otherwise, people might be on their second bottle of Cabernet.
Don't speak too soon, Manus. I think our last story is a pretty big negative for the multifamily sector.
Yes, this is one more negative story. Again, this comes from remittance data. The property value of NEMA San Francisco, which is a multifamily complex in the Bay Area, was cut and is now well below the loan balance. The complex, which totals about 750 units, was sent to special servicing in August. The complex itself was valued at $550 million in 2018. This month, the value was lowered to $279 million. So we're talking about more than $100 million in negative equity. We know that DSCR on that particular property was under 1.0x since 2020. I believe either a Whole Foods or a Target closed recently in that neighborhood due to quality of life issues. The owners of the property were noting that the cash flow no longer covered debt service and that they were forced to provide big discounts in rent to get people to sign up. So not a good story there in the multifamily market. I will say anecdotally on the other side of the coin, because I do want to end on a high note, we did see several multifamily loans in the CRE CLO segment pay off this month in full. I know that's been a concern for many data watchers and multifamily investors, that the high interest rates, the interest rate caps and so forth were going to lead to a sharp uptick in distress. We did see many, by many I mean north of a half dozen sizable multifamily loans pay off at par this month that backed CRE CLO debt. So a green shoot in that area to close this particular segment.
Yeah, it's great news on the CRE CLO front. I mean, there was, and there probably still is, a high likelihood of some of those operators facing some challenges, but it's good to see, at least in this, you know, small subset, that they were able to get out from under those arduous terms and maybe get into some more, you know, operator-friendly financing arrangements.
Okay, let's turn to shout outs. Deborah M., who is a loyal listener, I actually got to meet her in the office this week. We've met several times on Zoom and always emailing and tweeting at each other, but never in real life. So If you don't believe me, you can check Twitter. There's proof of us meeting. We made her pose in front of our Trepp sign and we gave her a podcast t-shirt. So it was great to see you, Deborah. And on the topic of our office, we had some very generous care packages sent to our office this week from a loyal listener, Miles F. So thank you so much for listening and the kind notes that you wrote each of us. He is hoping for less crabgrass as we head into 2024. So no promises.
I have to say, Haley, before you get into more shout outs, we're going to have to start adding an intermission both halfway through the podcast and halfway through the shout outs. We're getting so many people reaching out to us. We're going to have to give intermissions like they did in the old Godfather movies.
We might need a special episode that's just for shout outs and comments and things you want us to talk about that we haven't gotten around to. So stay tuned if you want that. On another note, Anthony K or Darkfire Capital on Twitter, in exchange for some podcast t-shirts, he sent us some of his son's signed baseball cards. So thank you for that. That was pretty cool. Alex K is a longtime listener and said he's a first-time emailer. And Manis, he hated to tell you this, but he said his old man was at one of the Allman Brothers shows that we talked about with Ethan Penner. So I know you were a little jealous when you read that email.
Absolutely. We went back and forth via email, and that was a great story. And yes, I wish I was there. It sounds like a wonderful evening of music and CRE.
Brett I thanked us for another great podcast, and he had some questions about the Sunnyvale, California lease extension for Google. I think we were still digging into that, Manis, but maybe we'll have an update soon. Matthew L. reached out to me on LinkedIn, and he said the Trepp Pod is easily the best CRE market update out there, so thank you. Clinton B. sent a note to Stephen Bushbaum after seeing him at the SIOR conference, and he is a big podcast fan. Solomon K. listens every week, and he said he's a law student at the University of Michigan. Jeremy B. is a longtime listener. Ethan W. listens to the podcast religiously. Our friend Oz also reached out about the payoff report. We had a bunch of people reach out after we teased a segment from Lonnie's panel with Olshan Group, the law firm that we had a distressed debt panel with last week. Patrick P, Matt C, Minaj R. And then on Twitter, we had a lot of people tweeting at us. Justin R finally heard Lonnie live. He said he's bringing the same humor and data he hears every week on our podcast. Brent D also said he saw you at that same event. Shlomo thanked us for our commentary last week. Bo B also sent the same sentiments, and as well as Ben P.
And I had a couple too, Haley, that I'd like to throw in. I got an email from our friend Brian D from out in San Diego that one of his brokers into the office loves the podcast and wanted to know that one of his brokers in the office loves the podcast and was shocked when Brian was able to tell him that he'd had dinner with us a couple of times. And so we have podcast t-shirts headed out your way, Brian D and Matt H out in sunny San Diego. So hopefully you enjoy that. And I was out in Kentucky, as you mentioned, based on the shout out there from Justin R. And I wanted to just thank Jeff White and the crew out there that invited me to come speak to their Kentucky commercial real estate group and the CCIM group there. It was a really great time. And it's just really great to see and hear from practitioners all across the U.S. There's some universal truths in the marketplace that we're all dealing with, and it's a little bit nuanced in every location. But there's a lot of really positive and productive energy in Kentucky with some of these battery plants and other things moving into that area. So really great for me to kind of get a feel for those local markets. And we appreciate our listeners to help make those things happen.
And actually, one more thing before we close. I did see that Lonnie was gifted a muscle tee after Manis made the joke, and we had some comments about him being the Pat McAfee of CRE. So there is a muscle tee that's in your possession now. Maybe one day we'll share that with the world, but not yet.
Yeah, if I can get on some push-up and bicep curl routine over the next couple of months, then maybe we'll take a photo where we can do an action shot. But I don't think I'm quite muscle tee ready at this point.
Yes, if anybody has the same idea for me, a very loose-fitting long sleeve t-shirt is my shirt of choice with something that has ample room for my one pack.
And before we close, I think it's time we can officially announce to all of our listeners that we have passed the 1 million listens mark. So we mentioned this the other week, and last weekend we saw that number tick past 1 million, and we are just so excited and grateful and thankful to all of you who take time out of your week, tune in, email us, send it to your friends. We love to hear that you guys learned about the podcast from someone else or you heard someone talking about it at an event. So just keeping it coming, and we're on the road to 2 million.
That is wonderful. You know, it is so much bigger and better and more exciting than I ever could have imagined when we started this 3 years ago. It is a great story and just so much fun. And thank you everybody who has listened, lurked, emailed us, tweeted at us, LinkedIn us, and everything in between. So it's a pleasure to be part of this and a pleasure to be working with Haley and Lonnie and all their predecessors. So great stuff.
Yeah, I agree. This is definitely the highlight of our week, and we feel honored and blessed to be able to just talk about what we love every week and bring it to our listeners. And to see that number pop up on the screen is pretty remarkable. And we're not satisfied yet. We want to get to 2 million. We want to get to 10 million. So we appreciate the continued support, liking, sharing, telling your friends about what we're producing and putting out there. And as always, just send us an email if there's things that you'd like for us to touch on or things that we can do to better enhance your listening experience. But again, just a heartfelt thank you from all of us here at Trepp.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the Treppwire podcast with your favorite provider. Thank you for listening and stay well.
All right.